So I mentioned earlier, about why we're creating this new listed investment company, and I was asked a question outside. Someone said, "Well, where does it fit with all the other funds?" Now, what you've got to remember with all the other funds, like if you want to invest in large caps, then it's WAM leaders. If you want to invest in mid and small caps, it's WAM capital. If it's micro caps, it's WAM micro. If it's alternates, it's WAM alts, etc. Where sort of WAM Income Maximiser comes in, and this was, as I mentioned, it was seeing over a number of years significant interest of people looking for that lower risk regular income. We sort of started with a blank sheet of paper. I think 4 years ago, what was it called?
Operation Eagle was the name.
It was called Operation Eagle, was to find a product that can do that and give you monthly income, but really have the right combination in terms of not just create another equity portfolio, and there are listed companies that do pay you monthly income in an equity portfolio, but at it with sort of high quality investment grade debt, and that's mainly bank debt, and have flexibility to move that around to give you, so the monthly income is covered by the flow through of the various yields. And there's a lot of people who've been invested in our listed investment companies for a long time, and the dividends we pay out is a combination of dividends we receive, but also capital gains that we realise. And some of you might have been invested in WAM Capital back a number of years ago, where we had to cut the dividend because we had a tougher period. So the logic of this product is just something that can continue to pay monthly income. Now, in terms of, why don't we go, and you'd be aware we've had 2 webinars. We had record number of, I think, questions at the first webinar and people attending. And someone who listened to both webinars, they said, the questions at the second webinar were exactly the same as the questions at the first webinar. I said, well, because everyone asked the same questions. And what we're going to try to do is, again, answer those questions for you. So, Matt, just as, can you just sort of tell us, what's your, how would you describe, I've tried to describe it in my words. In your words, how would you describe WAM Income Maximiser?
I think you did a great job. Exactly. I mean, it's really the combination of adding bonds into a portfolio, that sustainability of income. So, and when you add bonds, and we're talking about the government bonds, not government bonds, but the banks, which the government are taking away the access to the tier 1 hybrids. We're going to invest in the tier 2, which is not available to retail investors. So we're giving access to a market where they can't get it currently. But for us, on the equity side, we get to pursue some capital growth. Whereas if you're running an equity-only strategy of a monthly income, you really have to hunt in a high dividend universe, which gives you a real big style bias. It's the low PE value trap. So we think the combination works really well. And the whole idea is to have a sustainable income. So the majority of the income comes from the running yield of the portfolio. So we're not relying upon strong equity markets to pay out a distribution. So for me, it's the difference. The structure has got advantages, but the running yield of the portfolio, effectively you could say it's lower risk than a equity-only strategy.
And just on the debt part of the portfolio, because everyone say, oh, well, that's new. You guys are equity guys, and someone asked me, oh, will you have mortgages in there, and you just want to take through what'll be in the debt part of the portfolio?
So predominantly the core part of the debt portfolio will be subordinated bank debt, so the major banks, CBA, ANZ, Westpac, NAB. Also Macquarie Bank, investment grade. We're not going up the risk spectrum to get returns. We're not going into mortgages or mezzanine finance or private credit. This is investment grade. Really big difference. So the highest quality form of debt you can get. So big difference. Yeah.
Okay. And what you'd be aware, when you read the prospectus on the board, myself and Kate, but also Kurt Zuber, who was treasurer at Westpac for 16 years, and I know Matt, you were saying the other day, Kurt's been sort of very, very active in terms of already. Said, oh, look, if you want 50 million from this bank or 50 million.
I think he's got the itch back. He's been out of the treasury markets, and he's contacting all the desks for us. He's on our chats, and he's totally engaged. So it's been a great addition to the, and also Damien, I guess, been a great addition. And
just on that, Damien, do you want to, for everyone, you've joined us more recently, give everyone your background, probably starting with at the RBA.
Yeah, hello everyone. So yes, I joined WAM at the turn of the year. My career started many years ago managing the FX reserves portfolio at the Reserve Bank of Australia. So the Reserve Bank had at the time $45 billion worth of money invested offshore, and it was invested into US government bonds, European government bonds, and Japanese government bonds. In addition to that, the way that it managed that portfolio would from time to time impact the domestic market. So there was some overlap with Australian government bonds. So that's kind of where I've lived in the early stages of life. Also did a lot of work with regards to foreign exchange management of that portfolio. Through time, as we were there, we weren't just managing it, we were looking at ways to actually improve that portfolio, including researching other options. For example, the Norges Bank is a central bank overseas, which is a bit of a market leader, a bit of an innovator when it comes to investing the wealth of the nation abroad. And they were doing things like investing into mortgage-backed securities or corporate bonds or certain forms of asset-backed debt or even equities. So a lot of familiarity with those sorts of products from the perspective of working at the RBA and looking at potential options to do things a little bit differently. After I left the RBA, I've been working as a sell-side equity strategist, so within Credit Suisse and then later on with Barrenjoey. And the idea there was really to take a lot of the top-down macroeconomic intel with some improvements and apply it to a totally different universe, that is the stock market. And what I found as the years went on, so over 20 years in that sort of area, was how similar actually the information was between what people would invest in bond or fixed income markets compared with what they would see in equity markets. And I think I found that really exciting because A, it made my job a lot easier, but B, I started to see how that approach of taking macroeconomics and applying it more generally was actually really becoming quite influential and additive to an investment process. So that's broadly where I've been, and I'm really excited to have joined WAM and in particular to be working on this product.
And Damien's been a known entity for our group for 10, 15 years, and Damien and I have been speaking almost daily for 10 years because we're both macro tragics and we love, we're up at 12:30 at night watching the US CPI come out and exchanging information. So he's been a known entity to the group and is a great addition.
And Anna, do you just want to talk a little bit about the equity part of, because we spent a little bit of time on the debt, on the equity part of the portfolio, and just sort of, Anna, about the investment process and how it's different to WAM Leaders or WAM Capital, etc.
Sure. So as we've touched on, the debt really allows us flexibility on the equity side, more so than a traditional income-seeking product. What this means is that we have created a proprietary screening tool that we believe is quite powerful. We not only look at the dividend yields, but we look at where these come from. Why are they yielding the dividends that they are? And often that comes down to free cash flows. Why are the free cash flows strong? Are they growing? What's the volatility of them? These are all the things that we are looking at in this proprietary screening tool. From our investment universe, being the ASX 300, this is then narrowed with the screening tool, and then we apply the WAM process that has been used for over 25 years. So on the WAM process side, the key pillar for us in the large cap end of town WAM leaders is the macro. Matt has spoken to that earlier today as our view on the macroeconomic environment. And then we look at fundamentals, we meet the companies, we take a view on the earnings drivers and how they are changing. And then lastly, positioning. This is a big alpha driver for all our funds. Where are we different from the market and how is that going to generate us excess returns? So the differential really is that screening process at the start, and then it's the proven WAM investment process.
Great. So effectively, in summary, we're trying to find large growth companies that can pay high dividends, but a growth, not just yielding.
Yeah, they can pay a dividend now or in the future.
Yeah,
So that excess
that
cash
will grow.
Yeah, correct. Yeah.
Excellent. And in terms of, just like what other questions have people been asking?
I think the biggest one for me is around interest rates. So with a hybrid, let's say the RBA cut rates 200 basis points yesterday. The next time the coupon resets, your income's lower by 200 basis points. The goal of WMX is to eliminate that risk. So, our goal is to forecast interest rate movements, and we can protect against that. So we can change whether we go between fixed and floating. So I look at this as an enhanced hybrid where someone's managing interest rate risk for you. So that's a question we've got a lot on the road is what happens with interest rates, and we're trying to hold the dividend at that high level through the cycle. That was a big thing I got.
And so now, because I know you guys have been running a paper portfolio, like how would you be?
Yeah, so
how would it be positioned now between debt and equity?
Yeah, so about 4 weeks ago, we moved to a 50-50 asset allocation. So we were nervous, like everyone in this room was nervous. The yield we were getting on equities was 3 and a bit, 3.1, 3.2. On the bond side, it was 5.95, 6.1. We're like, risk reward, given the uncertainty coming, we're like, let's tilt towards bonds. So that's the beauty. During this downturn, the paper portfolio was up because 50% of the portfolio actually went up in value. This is the advantage of having the mix between bonds and equity, whereas equities were in a drawdown, but where we were looking on the equity side, they fell less than the market anyway, but half the portfolio went up in value. So that's the beauty of this product is this volatility doesn't bother on the bond side yet. I mean, it could on the credit side, but again, we've got levers where we can pull and protect against those movements.
And any other questions, on the road? We've been to Canberra, we've had, spoken to a lot of shareholders that you guys have been asked or specifically would like to, any other highlights?
Yeah, I think a lot of people are asking the question about premiums and discounts to NTA. Why would you pick up the product now at IPO versus later? And there's actually some science behind what we have to say about that. Because what you're finding at the moment is whether you're talking about listed investment companies, whether you're talking about the general equity market, as Matt highlighted before, anything that's offering you a quality income at the moment is outperforming. Within the LIC space, you're seeing that those that provide you not a quarterly income, but a monthly income are trading at a premium. What you're finding at the moment is that there is an insatiable appetite across the board for income, high frequency income products. Why is that? Number one, there is a structural element to this. So as Nick highlighted before, he showed you the allocation of a superannuation fund. And a lot of that allocation fund at the moment is invested in, the alternative asset class bucket. So a lot of superannuation funds are quite full of that. And a lot of superannuation funds are also quite full of long-term government bonds. They will need to diversify, particularly after the uncertainty that we've seen. And that diversification naturally pushes them into credit markets like subordinated wholesale debt markets for banks. So that's number one. Number two, structurally, hybrids, bank hybrids, so-called additional tier one capital securities are being phased out. And they're being phased out at quite a brisk pace. And the money that's displaced needs to find a home. So it needs to find a like-for-like income product that matches the risk profile of the people that would invest in those in the first place. So there are two structural reasons why income is in favour. Cyclically, what we found, and again talks to Matt's chart before, is that there's been an incredible amount of crowding in companies that don't pay you anything today, but promise to pay you a lot in the future, well down the line. They're what we call long duration growth type companies, and they've become extremely popular in the last little while. As Matt highlighted, they've now started to unwind. And if you're not going to be in that really long-term payoff market, well, the natural alternative is to be in something that's actually paying you now. So whether you're looking at this cyclically, whether you're looking at this structurally, there is overwhelming demand for income-related products at the moment. So we're really pleased to be able to offer something like this to the market right now. We think it's actually a great time.
Look, yeah, thanks, Damien, and a very good point, because we did a survey the latter part of last year of our, the annual survey of our shareholder base, and I think 63% of them, we asked who's interested in monthly income, and I think 63% said they would. Look, thank you, Matt, Anna, and Damien.